The Total UK Pension Plan's £1.6 billion buy-in completed earlier on this year was one of the largest of its kind to be completed in the UK pensions market. Joining me in the studio today to talk about the exercise, the challenges and the lessons learned are Lester Farrant, UK Group Pensions Manager at Total, and Mitul, Magudia, Actuary at Pension Insurance Corporation. Welcome to you both. Lester, if I can just start off with you, can you give us a little bit of background as to what were the objectives for doing the buy-in?
Yes, Helen, yeah, I mean, we, as a pension plan, are quite large, overall assets or liabilities of £2.6–2.7 billion. Quite mature, we've got lots of pensioners, and I suppose like many big pension schemes, over successive valuations we've taken lots of hits on things like longevity, and we've seen those valuations working against us. So we, between the company and the trustee, were looking at ways that we could de-risk that, so take some of the volatility out of the funding, give the business some more certainty, and for the trustees, more guarantee that they're going to be able to give their members the benefits. So it's really about taking some risk out of the system.
I think the objectives of the Total plan are very similar to other schemes that we talk to in the market and come and ask about transactions. I mean, typically, the one sort of difference that you do see is between the company and the trustee. So sometimes we see company-led processes for pensioner buy-ins, and their main goal tends to be controlling funding and the volatility of funding in particular. So they're looking towards their financial statements and seeing if they can control some of the sort of ups and downs that they get from year on year. As opposed to the trustees, who typically tend to be looking for either security of member benefits or further de-risking of the investments as part of a journey plan they may be on. And in this case, it was a combination of both from our perspective. I think we had both the company and the trustee looking for slightly different things, but areas in which both could benefit.
Great. Lester, what alternatives did you consider alongside doing a buy-in?
Well, as far as the scheme was concerned, over the years we'd de-risked some of our investments. So we had quite a significant holding in index-linked gilts, a few corporate bonds. We had quite a chunk of Network Rail issued some index-linked bonds, so we had that. So we were moving towards de-risking, but doing it very simply, as straightforward as we can, not going the full LDI route. We felt that was too complicated. But a couple of years ago, I suppose, we started looking at the longevity risk, and in particular looking at longevity swaps. There have been quite a few done in they were in the press. So we started looking at that. But it came a point where the market moved a bit, and we became aware, if you like, that we could potentially do a buy-in at about the same cost that it would be to us for a longevity swap. So if we were going to spend money, why not spend money that takes more risk than just longevity off the table, take out the investment risk as well. So it was a long project. Started off, I suppose you'd say, longevity swap, because we had all our index-linked gilts and things, felt we were fairly well protected. But turned into something bigger as the market changed, I suppose.
I mean, pension schemes have, in particularly large pension schemes, are inundated with various routes and solutions and options with which to manage all of their different types of risks. And I mean, Lester mentioned longevity swaps being an obvious one for longevity alongside buy-ins, as well as just investment de-risking. There are other big solutions out there for big schemes like captive insurance companies and things like this. So it's often quite difficult to sort of make your way through all of these solutions and try and understand which one suits your scheme best. And certainly any kind of investigation that goes into true depth takes some significant time, and there's only a limited amount of resource that any pension scheme has, or amount of cost it wants to incur in looking at all of these different options. So often a good way to do that is to find an advisor who's impartial to any of the results, if you like, and through that you can get sort of an unbiased, generalised opinion as to which one offers the best value and fits the scheme in the best way, and is best for the members in that scheme.
I mean, Lester, can you tell me how was the buy-in achieved?
I suppose I should say by putting lots and lots of hours in. I think what was good from our side, I think as Mitul said, we really had the company and the trustee aligned in terms of wanting to de-risk and searching for the most appropriate way to do that. So I think getting that agreement of the way forward right at the outset was very important. But as Mitul says, we only have a limited resource in-house, so we needed to find ourselves a good advisor to help us through as Mitul might call it, simple. I mean, from our side, it seemed quite a complicated path to go through. But from that, we were able to then go through a series of quotations with various insurance companies before homing in on a pension insurance corporation. So yeah, a long process. But I think it was key to start with that we got the company and the trustee basically recognising they had the same objective. I mean, ultimately that they have the same objective, which is to deliver to the company's staff their pension that they've been promised. So it was great to start from that. I know sometimes we hear that there's maybe a bit more conflict. Well, I don't think we ever had that position as we went through this.
Yes, I mean, I think I say simple, but I think I'd add to that, but thorough in this particular case, because both the trustees, trustees advisors, the company advisors, and all of Lester and Lester's team were very interested in understanding every aspect of the transaction in full detail. So that required intense work from all sides, really, to understand and establish what was being done. Typically, that sort of full information only really resides in the hands of a few people in a normal transaction, whereas here there were teams and company and trustee individuals that were all finding out every aspect of the whole transaction, which made it significantly more intense, I think, in terms of sort of how long it took. I mean, in terms of how was this actually achieved, as Lester mentioned, a joint working party was set up between the company and trustees, which established a streamlined process and also quick decision making. It meant that they were open to new ideas and also tweaking the transaction in a way that suited them, but also listening to what the insurers and what Pension Insurance Corporation had to say and fitting something that worked for both sides.
And Lester, I mean, what was the outcome of the transaction for the pension fund and the organisation?
I think there's probably no difference in outcome for both because, as I say, common objectives. What we've done is to take a big chunk of risk out of the scheme. We have got security of our cash flows now, so we're not worried about looking to disinvest certain of our assets. Okay, you could argue we have because we've swapped all our index-linked gilts for a buy-in policy with PIC, but that's now provided us that security of income from those, so we're not looking to maybe have to sell assets at a time that might not be good for it to fund next month's pension payments, and we really don't have much choice. I mean, those pensioners will not be happy if that money didn't arrive in their bank on the first of the month every month. So I think that security and taking a big chunk of risk off of the table as far as the scheme is concerned.
Seems like there's been a lot of lessons learnt during this process. What advice would you give to other schemes who are maybe considering undertaking similar transactions?
I think there's probably a few bits of advice. I think the key one is we talked about being sure that that is what you want for the scheme and the company, because if you don't work together, it could well have a bit of a funding impact and the company is on the hook for that. So that's key. And I think the other thing is data. You need to be sure that your data is as good as possible. The better you can get your data, the more accurate a quote you'll get from the insurance company, the more confidence they'll have that they're actually quoting for something you really have. So nobody should underestimate the time involved in getting your data as clean as possible. That's, I think, key.
Mitul, anything to add?
No, I mean, I think that's exactly right. I think I'd reiterate some of the earlier points on having the ability and the willingness to transact. That the knowledge of that alone is so useful to schemes before they even approach the market. And I think it certainly leads to a better process, both from their perspective and from the insurer's perspective. Secondly, I'd reiterate Lester's point, which is getting everything lined up, having your benefit specifications reviewed by your legal advisors, your data clean so that everything's ready for you, and assessing what the potential funding strain might be, either on an accounting basis or a technical provisions basis. All of this information can be done by your advisors before you even come to the market. So it's very much a case of getting ready so that you don't find a point in the year where suddenly you think, actually, now's a great time to do a buy-in, but you're not ready. You've got to go through all of these steps and actually you find you miss the opportunity, because it's not something you can just do overnight. You can't just press the button. It takes months and months really to go from even a scheme as developed and sophisticated as the Total scheme was. It took around about 6 or 7 months from the moment the process began to actually the final transaction. And more broadly, for other schemes, my advice would be around the sort of supply-demand dynamic. What we are seeing at the moment is a bit of a shift towards more demand rather than supply. And given the amount of defined benefit pension liabilities that are out there in the market, that's an inevitable result over future years. So what we're seeing is that this year in particular, 2014, has seen the largest ever buy-in, which is the ICI transaction, the second largest ever buy-in, which is the Total transaction, the largest ever buyout, which is the TRW transaction, and the two largest ever longevity swaps with the BT and the Aviva schemes. So those 5 transactions alone cover around about £30 billion worth of liabilities. So you can quite quickly see how, if momentum starts to move towards schemes looking to de-risk quicker and favourable pricing is available in the market, how the demand is going to increase to a point where insurers will be more selective about who they quote for. Pricing will inevitably go up for some schemes, and you'll see a case where actually schemes end up pitching themselves to insurance companies rather than the sort of reverse situation where we are now. The flip side to that is that there are more insurers coming to the market, that the market is expanding, and also with the recent budgetary changes, some of the other more established insurers are moving away from the individual annuity market and into the bulk annuity market, which is providing more capital and cheaper pricing by results. So there will always be a balance to look out for in terms of supply and demand, but it's something that I would always recommend that schemes get themselves ready. Even if they don't want to transact, they have no obligations to transact, it's something that's useful to do, and then when they're ready, they can press the button.
Great, thank you both.
Thank you.
We've come to the end of today's pension scheme case study. I hope that you've enjoyed it. I'd like to take the opportunity to thank our participants, Lester Farrant, UK Group Pensions Manager at Total, and Mitul Magudia, Actuary at Pensions Insurance Corporation. And thank you all for watching.